Hello, everyone. Welcome to the Income Masters channel. It is June 18th, 12:30 p.m. Eastern. You're here with Dave Durham, and my name is Emily Norris with Traders Reserve. Just want to let you know we are recording this session and we'll post a replay to the platform. If you have any questions, you can pop those in the chat while we're going through the presentation, and we'll get to those at the end. With that, I'd like to take it away, Dave.
All right, thank you, Emily, and welcome to another Wednesday here session where we're trying to do a deep dive into tactics. I mentioned this yesterday. We're going to do assignments, talk about assignments today, and again next Wednesday. This is part one. Basically, make sure everybody's on board, understanding assignments and avoiding, and then help with how to avoid option assignment. Some of which we touched on last week. I think we'll dig into more details here. I also going to cover some things that may be a little bit basic to some of you because I got some questions that I want to make sure everybody's on board and starting from the beginning. So again, this is part of our daily schedule for Income Masters on the Income Master channel. Tomorrow, the market is closed, so there is no session, either trading or education. But on Friday, we'll get back for review and position coaching and follow up a little bit on this stuff today as well. So keep that in mind. And again, as I said, we're going to do this in two parts. Today will be basically understand and avoid, and next week will be, okay, now you're assigned position, best way to manage it, or different practices to manage assignments. So look at that next week on the 25th. Both sessions today and next week will be recorded. So if you can't make that session, I understand. We were trying to get these done before we head into that last week of June, well, really first week of July, June, where there's kind of a holiday in the middle, or not in the middle, but the end of that week, July 4th. I know people may be traveling around then. The agenda today, basically talk first, just again, make sure we're on the same page, your trading account and assignment. I think we're all pretty set on this, but I want to just make sure we are all can be on the same page and go forward on this. Then talk a little bit about exercise and assignment and the difference between the two. I think, again, most people know this. But then some help on determining assignment risk. This is the biggest part, which is basically, okay, now we're in the trade. When we're going through the trade, how do we, as time ticks off, how do we assess the potential for the risk of assignment, not just in the fact that the stock is moving up and down or the stock is heading towards in the money, but how can we get some help on looking at that there? Then avoiding assignments with a management of the position or adjusting the position to avoid assignments. We've done that a number of times over the years here, but we'll go through that with some additional help there. Then just briefly talk about planned assignments. Sometimes we do want to take assignment of a stock or be called out of a stock. So I'll touch briefly on that, and then we'll wrap up today's session. All right, your assignment. I put this up here. FOA, you hear FOMA, fear of missing out. Well, FOA, fear of assignment. Really, I think it's more annoyance of assignment. That's I think most of us have gone through assignments, and it's not something to fear. It's just a pain because it's a couple things. You have to deal with the assignment, and secondly, when you don't want to be assigned, you now have a position that's put into pressure in terms of trying to collect profits from that trade. So we all have that look from, that says, why I just got assigned. Okay, I got to deal with it. Here comes the annoyance. As you probably know, you'll get a note from your broker if you're assigned, but you can be assigned on cash secured puts. You can be assigned on buy rights or covered calls and have your stock called out by a covered call. You can also clearly spread trades, which we trade a lot of. You can be assigned on the put or call side. And there's other option selling tactics, iron condors and etc. Butterflies. You can also have risk assignment there as well. The short put assignment on a cash secured put is pretty straightforward. I think everybody's been through this. You must have the cash in your account, obviously, to open that trade. But then you also have to have that account for the very reason that if you were to take assignments, you have to be able to cover the cost of buying that stock position. So if you sell one ABC 20 June 90 put and the stock trades to 87 before expiration, you can be assigned early, and you must have $9,000 of capital in your account to cover that, support that trade. unless you're trading on margin, which we don't do. If assigned on the 2090 put, the stock, you have to buy the ABC stock, and you now own that 100 shares of that stock. Get it? We all have gone through that. On the spread, it's the same thing, whether it's a put or a call. If you're assigned on the short put, you must have the cash in your account to support the trade or buy the underlying. If not, you or your broker will have to sell that stock at the market to clear the account, or sell enough of that stock to clear the account so you can trade again. There's nothing wrong with that. You're not in violation of any SEC law if you don't have the money in your account. Your broker's not going to all of a sudden exercise and close all your positions unless you're on margin. If you're on margin, that can be a whole different thing, but we don't trade on margin. So, for example, if we open 3 contracts of ABC stock for the June 20th expiration, and we sell the 450, 450, 445, meaning we sell the 450, buy the 445 put spread, and we get assigned early, we would have to have $45,000 per contract or $135,000 of cash available in our account. Some of us may not have that kind of $135,000 sitting around in cash, even if we have a large account. And if we do, we may not want to have that much stock in our account, or much $135,000 of ABC stock. Even if we like the company, we may not want to have that big a position. So again, that's what we deal with when we're with spreads, but just want to make sure we're all starting from the same page there on that. So I think that's pretty clearly understood, and we go through that. So exercise and assignment. Again, I had some questions on this. So I want to make sure that we're all there, understanding what we are talking about. I think most of you know this. What we trade are both stock and ETFs are classified as American style options. That means they can be, the option buyer can exercise those at any time before expiration, and for any reason they want to. So whether we're trading a market like the SPY, the Qs, or the Russell 2000 IWM, or an individual stock, they can be assigned early ahead of expiration. If you're trading an index, like the SPX, which is the SPY, it was the S&P 500, the NDX, the NASDAQ, or the RUT, which is the Russell 2000, is an index, they can only be assigned at expiration. Basically, they're European style options, and there's no early exercise and no fear of early assignment. So when we look at that, exercise is, and I think, again, most of you know this, but I just want to make sure everybody's on the same page with this. The option holder has the right to convert that option into an underlying security. So if they're buying a call option, the buyer exercises to buy that stock at that strike price. So if you bought stock at $98 and it's now trading at 100, and you sold the 99 call, and that buyer could exercise that option and call the stock away from you at 98 or sorry, 99, and you will have to forward that stock to that person. The put buyer, same thing. If they exercise to sell the stock at the strike price, meaning if you sell a $100 put, or sorry, you sell a $98 put on a stock, and the stock trades down to 96, you have to take assignment of that stock at the $98 price, even though it's trading at 96. Again, I think we all know this. But again, exercise can only be done by the buyer. We, as sellers, are generally the recipients of assignment. And again, it can be any time. Particularly remember when call options sometimes happens around ex-dividend dates, because the option buyer of your call may want to collect that dividend as well. And we've seen that happen from time to time. Assignment to the option seller, you are assigned the obligation when the option buyer exercises their options. So again, if on a short call, you must sell the 100 shares if you own, but if you're assigned on a short put, you must buy the 100 shares. So only sellers of options can be assigned, and you can be, again, assigned early, not just at expiration. All right, let's get into determining risk here. Now this is the sort of the meat of this presentation. Basically, we've all seen the short put, which is the sold put, goes in the money, whether it's a cash secured put or put spread, we are at risk of assignment. So here's a few option metrics you probably have heard of, but maybe want a little more clarity on. Its intrinsic value, extrinsic value and time value. Now, intuitively, I kind of use these and calculate them in my head, looking at my Thinkorswim screen, but you can also add those to your screen if you want to, and we'll look at that a little bit later here. Intrinsic value, basically, this is the definition. It's the amount by which an option is in the money. So if you're short put or on a spread or in a cash secure put, or your long call is out of the money, there is no intrinsic value, and you don't have to worry about having intrinsic value in your position. So on calculating it on a call option, intrinsic value is calculated. You take the stock price and you minus the strike price. And that is, if that's a negative, then you have intrinsic value, because again, if you have $100, if you have $98 strike, strike and or $100 stock and a $98 strike, well, you're $2 in the money, and so you have $2 of intrinsic value. On a put option, strike price minus the stock price. So this is the opposite. Now the stock price is below. So you have a $100 put and the stock is trading at $8. You're now $2 of intrinsic value. So again, if your short leg sold option has intrinsic value, it is at risk theoretically of assignment, but especially as you get closer to expiration. And if your long leg, the bought option, is further out of the money, it may not fully offset the risk of early assignment near expiration. So we're going to talk about that a little bit today and a lot more next week because of the impact of the long put when we're doing spreads. So let's go out and look at a real live example. These are two stocks we have positions in right now: Palantir, PLTR, and Lululemon, LULU. The first one at the top here is Palantir. We have a July 11th, 118 put. We have a put spread of 118, 113 put spread. We've sold 5 contracts. This is for my live count. This was taken about 3 o'clock in the afternoon yesterday. Wanted to add this in. Stock is trading at 138. So clearly our sold put is well out of the money. And that means we have no intrinsic value. I added these in just for show and tell purposes here. So that's pretty clear. We don't have to worry about, right now anyway, we don't have to worry about assignment on Palantir. Lululemon, which we've adjusted and rolled a couple times now, have an out to roll to the 18th of July, is still in the money. We have a 250 put that we adjusted, 250, 230 put spread, and we have $235 strike or stock price. So basically we are well in the money there, almost $15. And you can see that shows up here as 1447. That's the 250 minus the 235.50 equals 1447. And again, by the way, these are live. The market was live then, so these numbers are going to not quite fill in right all the time. So I just calculate it in my head. I don't think with Thinkorswim, if you're not seeing a lot of volume come through, sometimes the numbers look a little wonky there. But that's the way you see that. If you can, I don't always put up intrinsic and extrinsic value on my screen, because all of a sudden when I want to see delta, theta, either out of the money, in the money, all of a sudden this line gets very crowded, particularly because I'm showing it in larger type for when I show this here on the screen. But you can add that in there if you want on your Thinkorswim screen, and you can get the same on most other option broker screens as well. It's extrinsic value. So the definition of this is the value of the option above its intrinsic value, primarily due to time and volatility. And I'll show you the calculation on that. It's basically extrinsic value is the option price minus the intrinsic value. So if you have a an option position, a sold option position in the money, it's simply the opposite option price minus that intrinsic value. And why is this important? Well, in the money options are less likely to be assigned if they still have intrinsic value. So the buyer benefits by selling the option rather than exercising it. So they can just sell the option to somebody else. And as intrinsic value drops, though, and gets near expiration, that's where the risk of early assignment increases sharply. So we'll go out and look at the same 2 stocks and the same 2 screens because we have one out of the money and one in the money. So with Palantir here in the yellow, or the yellow highlight here, Palantir there, again, we know we're out of the money, so we have no intrinsic value, but we still have extrinsic value because we just take the stock price minus the option price 0 minus 99. Actually, so again, this is why it looks a little wonky. This 150 compares to the 151. So the 150 is intrinsic value that we have. We have $1.51. Again, I don't know why it's not rounding up to $1.51 there and why it's $1.51 here. Probably because maybe I don't have enough decimal points set up. But again, this gets very crowded. And it's 99 cents here and $1.21. Not sure why that's not the same. But effectively, that is, you can see why intrinsic value is the same as what the option pricing is right now at the mark. Lululemon has, we talked about this before, has the in the money 235, 250, and we have that 1447 of intrinsic value, but we also have now extrinsic value, $8 here, which again really is probably 770, and 432, and it's the 1925 minus 1447. That's the difference, 432. And so we have extrinsic value of $8 and 432. Now, this is a lot due to the fact that we're still 31 days out. So even though we're in the money and there's some risk of assignment, and it's not going to be worth it for somebody to give up that, do this for, they'd rather sell this option back and collect the difference between 1440, what they paid for it, and the $19 rather than trying to exercise it and lose that $4.42. They don't make enough money on that. So with intrinsic value still in there, we are okay, not 100% okay, not for a while, but at least at day 31, now to day 30, depending on what the stock price does. Again, this was down 5%, 2.5% yesterday. So that's important to look at when we look at different positions we have that are either in the money or out of the money going forward. The last one is time value. It's a subset of extrinsic value, and it represents the value of time remaining in expiry. Of course, early in the trade, time value is high, so assignment risk is rare. The further out you are, one of the reasons we try to go out 35, 45 days is there's a lot of time value, and if the stock moves in our favor, we can exit that trade early. But as expiration, just as anything, as expiration nears, as we go down the time frame and down the what I call the slide here, and in fact get into that last week, that's when time value decreases. So lots of time value is good. That means even if we are in a position of that we might be close to going in the money, we've still got the time on our side at that 45, 35 days left there. So this is a little cheat sheet, and I got even a more precise one that I use, which is percentage wise. But again, you can kind of look at this. If your short leg's out of the money, assignment risk is low. At the time, it's still out of the money, and you don't have to take any action. If your short leg goes in the money, but has still extrinsic value, low to maybe moderate risk of assignment, and that you need to monitor and possibly hold. So like our CRM trade there, we have some extrinsic value, probably enough that the person that bought our put is not going to go ahead and exercise it. They'd rather sell that put if they want to get out of it to somebody else. Now, if the short leg in the money and no extrinsic value or little, meaning it's actually gone from $4 down to 50 cents, there's a higher probability of being taken assignment. And then you want to close, if some people want to close that at a loss or roll that position immediately. And there's also, when you get to ex-dividend date, when we hold a covered call, it's the same thing there. If you're in the money and you have, again, that $100 stock, about $100, and your call is now at 98, and somebody wants to take that stock at 98 because there's a 50-cent dividend coming up. We've seen that happen before as well. They're going to take that stock to collect the dividend, particularly on the day before ex-dividend date. But that's really not the focus of today's session. All right, avoiding assignments. This is what we spent some time on this a little bit last week with the defending trades, and that's why we defend trades. To me, it really starts with setting up the trade. So the trade setup's important. We talk about this a lot. These shouldn't be new to all of us who've been listening in these sessions for the last weeks and months. Starts with the underlying we choose to trade. We need to have liquid underlyings, particularly they have liquid option chains. So it's not easy to trade something that's not very liquid. Enough said there. Direction bias. I mean, again, what's our direction bias? If it's pure neutral, we think this stock's doesn't need to move much or will not move much. If it's neutral to slightly bullish or slightly bearish, or even full-on bullish or bearish, that's a whole different thing as well. We like to get implied volatility with implied volatility rank of 30 plus, just because it gives us a higher probability of collecting a credit. Remember, we like to sell high, buy low. Days expiration, you can argue or quibble whether it should be 30, 35, 40, 45, 50 days, but in that range to start a trade. And ideally like to get that 40, 45, particularly because we're going out to a monthly option now, a month ahead of time. And then we also look at the deltas or the probabilities of finishing out of the money. And a delta at 15 kind of is a target we try to go for. If we can get lower and get a decent credit, we'll take it. And same with the probability out of the money. If we get a 15 delta, the probability of finishing out of the money is, sorry, that should be in the money. It's 15% to 17% in the money. So that means 85% finishing out of the money. The credit received, I mean, in a perfect world, you like to receive 1/3 of the width of the spread to get a 20% return. But with lower volatility periods, we get less than 1/3 of the width, but instead we target to net net target at 8 to 10% of the return there. So we look at that as the goal there. And of course, then the last part of the setup is setting a target price once we get into the trade. So on Income Masters, we've been spending most of our time in the 50, 55 to 60% range of max profit. Just gives us a good practice to get out of the trade and take our profit and go in case something changes. We set good no cancel orders when we set up the trade. And basically on a put spread, we would like to see stock appreciation and the change in delta, the delta lower. Call spread, we see the stock price decline, the change in the delta as well. And of course, we want theta decay work in our favor, particularly as we close in on that 20-day or less time period. That becomes our thing. So again, a good setup is important on that. And I think we've been trying to do that. We've been sticking to that a lot of times lately because we've been averaging. This is non-madness trades. It's a little bit different in madness. We went over those numbers earlier this week and last week. But on non-managed trades, we're averaging about 30 days in our DTE, meaning some trades are set up at expirations 40, 45, 50, and some are set up at 20, 25, 30. The average time in the trade is 15 days. So we're not staying in these trades the entire time. We're exiting it. We're hitting target exit prices. That day will go up and down, fluctuate depending on what we close and when we close it. And just some recent trades we did. We closed Netflix, a put spread in 8 days, Lockheed Martin, not the one we're in now, but one before this at 18 days, and the Spider GLD at 9 days. And the other way. And then finally, just to look at this, so that our averages, basically our IVR average has been, we set up a trade, it's been about 28.2. We're not quite getting 30. It actually escalated. It was about 25 to 20. When volatility shot up. The delta we've been at is at minus 18, so a little higher. When we do a madness trade, we tend to go a little more at the money or towards in the money. Our average profit target has been 56.8%. So we're not doing everything at 50% of max, but the average is about 56, 57%. Our average turns about 98.8%. So hello?
Hey Dave, we can hear you now. You cut out there for a minute.
Yeah, and something. Okay, are you seeing my screen?
Uh, Not your share screen. No.
Did I drop out there?
Yep, right about there. Yep.
Okay. So again, this is just I'll reiterate this slide is just about even though we have a good trade setup, stocks can and will probably move against our sold strike from time to time, or a bought strike if or a sold strike on a covered call. Lockheed Martin's a good example. We got in, this is the trade we closed, and I showed that it was open for 18 days. The day we got into it, or the day after we got into it, the stock dropped 5%, 2 days, totally unexpected before it bounced back. So we can do should and expect stocks to move up and down from time to time. So what we do is we monitor the progress of our spread trade. I think sure all of you do this. I do this all the time. I'm keeping an eye on where our trades are. And here's some of the guidelines I look at just overall, and then I'll get to some specifics as well. If our out of the money, and this is kind of whether you want to use intrinsic value here, out of the money percentage is what I look at, or intrinsic value. I kind of use this guy for if our strike is sold strike is 5 to 10% out of the money. Okay. And we're reaching 18-22 days. We probably are either getting close to hitting our target exit price, or we should be getting close in the next couple of days. And we're still, it has to be kept an eye on, but we're not in dire need of rolling that or adjusting that position. If we're in that 11 to 20% range, that's good shape. Should state indicate should help us hit our target any day, unless we had a more aggressive exit price. And when we're 21% above, anything 20, 25, 30% out of the money, we probably either have hit it or going to hit it very soon. So this is Palantir again yesterday, not today. I'll take a look at it today later, but we are 17, almost 18% out of the money. So we're kind of in this range of good shape. In fact, I looked a little while ago. We were about 10 cents off of our target exit. So we're closing in on that. And again, this is important, and avoiding assignment is keeping an eye on these positions. So, but when we should start to prepare to take action is when I start to look at it when our short option basically gets down to 3% or less, particularly under 3%. Under 3% means, and there's a lot of factors in this that play into it. You know, days to expiration is obviously the important one, but also what is going on with the stock, or what has gone on with the stock. Why is it now all of a sudden 3%, or has it been in the 5 to 3% range, 4% range since we've been in the position starting at day one? If the short option is not greater than 5% in that, particularly as we close into those last 2.5 weeks, then we're going to get ready to take action. So if we're at 4% out of the money and we have 14 days to go, maybe we don't want to play around with this position, because a 4% move is not a big move, particularly in some of the days we get here. And we have the risk of unexpected news or rumors impacting underlyings in those last 5 to 10 days. So we could look at closing early, or we could look at, and what I mean by close early, not at a loss, we could look at saying, look, we were hoping to get to net 50 cents or $50 a contract. Let's take 35 cents or $35 a contract. So that's an option we have if we think we have something that's showing a small profit, but smaller than we targeted. So what are our options? And then we'll get into even more specifics here. We obviously, the most common option, whether we roll something that's out of the money and to another position to avoid it going in the money, or we roll an in the money spread, we can roll the strike. We roll the position out, our expirations out, and we roll our strikes out. If we are in a put position, we may also add another side to the trade. We've done this with our 4 big ones, our 4 problem childs, which we'll get into in a second here, which is we've added a call spread to basically capture credit to pay for either the adjustment of the put spread, or to actually add a little extra credit to profit on the put spread. If it's the move, and we talked about this last week, if the move is too big, we talked about a trade reset, where we simply close the trade down and reset the trade to a new position, because we just, one, we're too far in the money and too far chasing the debits there, but also we still think the stock's heading in the right direction, the direction at least we had in our original trade thesis. And we can convert to another option strategy. We can go beyond the iron condor. We could add it into a butterfly, an iron fly. We could even shift it potentially to diagonals and other potential trades. We keep it fairly simple and trying to roll it into the position we have. But adding the credits, adding another side is usually the most, not advanced, but the most active beyond that. So, managing the position to avoid assignment. Our sole position is near the or in the money or has gone in the money. So the first thing we do, and we've done this live as well, is we look out ahead and review the underlying strike liquidity at the next 7 days out, 14 days out, 21 days out, basically those strikes that are further out, those expiration dates. And we've talked about the fact that some options, that stocks with weekly options may not have the liquidity to handle an adjustment, say to the 11th of July rather than the 18th of July. So that's the first thing we do. We get ready to manage our position if it's nearing in the money or just gone in the money. Obviously, once we select the best new expiry, and we want to make sure that expiry avoids any possible events. Maybe sometimes we can't help it with earnings, or there's a regulatory ruling, or we maybe have a Fed meeting or some kind of date that we'd like to maybe go beyond. We have that generally with some stocks, we have that opportunity to either roll it ahead of that or roll it behind it far enough out there. And then we assess the credit potential or the potential of a debit. So, and that's, when trades really go against us, we've been faced with debits. When trades are just either at the money or slightly in the money, we can generally roll those for a credit, and just the time rolling it out in time gives us the chance to recover that credit. So we're going to actually do one live here afterwards to go through that. So assignment potential, this is again, these kind of, sort of a checklist. This has been our experience over a number of years, 35 to 45 days. It's rare to get assigned. There's just too much time value in the short option, and too much extrinsic value, even if it's the option is way in the money. 23 to 34 days, there's still a lot of time value left, but the risk starts to increase. And then that's where that 18, 22 days, we got to be able to assess that risk and say, okay, we don't have as much time left now. That's the key time we want to start adjusting this trade. If the target price is not reached at less than 18 days, we may want to exit early with a smaller profit. And that's what I mentioned before, where we have a good trade, it's been out of the money, but the trade's just not moving. The stock's either trading flat or even maybe creeping down, sort of a little bit down each day. Exit early with profit. So that's why, again, this is one of my favorite charts and one of my most important charts, which is this time decay chart. I know it's a little blurry here. Let me go back here. Sorry. It's a little blurry, but you get the idea. This is that slide off the edge feeling, because once you get inside 30 days, everything starts to happen faster. When we get down to that last week, that's the gamma effect. So that's why we don't really want to wait too long on these trades. And we have sometimes waited on a trade that was slightly out of the money from a position of maybe it's 2% out of the money and we're now 7 or 8 days out. Do we stay in it? Then that's generally we're going to take action on it. But this type of chart, you can find them all over the internet. When you just dial up options, expiration, and option value, this is something to keep in your head as you're thinking about managing these positions. There are exceptions, and we went through this last year, and this is not to make excuses or try to justify some of these positions we're in, but we had some extreme volatility here on basically on the tariff threats and Liberation Day, and we had extreme drops in the market. So those we haven't seen. We've had drops. I mean, 2022 was a bear market, and we had down days, but we didn't have these kind of shock days, and we didn't have the spike up in this range of the VIX. I mean, the VIX did go up and did hold up there in the 30, 40, 50 range during that time, but not like it did this time, where the the extreme climb there was really put us in a challenge. So in extreme market volatility, when we had this kind of unhinged volatility, that means that volatility spiked and sent stocks over a cliff. And we had positions that went in the money with little or no time to react. I mean, and these are four of them that we ended up with challenged that we're still in. These were the trades put on in late February that we got caught in this whole downdrift, you want to call it, or I mean the explosion there of tariffs and the tariff war. We had assignments on all four of these. I think actually maybe not everybody did, but I know in our live account we had assignments. So some of these assignments surprisingly came up with 30 to 40 days to go. That's because they shot down so far in the money so quickly that we didn't have time to even react on these. And so this was a, you're looking at 30. I have not seen on a normal market environment many assignments come before 30 days. You can get some, but rarely do we see assignment on a position that goes in the money, particularly if there's extrinsic value and time value that you're not going to see it. But this happened to us. So this is the outlier to the normal trading that we do, and there may be more of that coming up on that. So, all right, we'll get into now. We're going to assign. That's what we're going to get into next week. Let me finish up with just planned assignments. This should be pretty straightforward for everybody. There may be other reasons you may want to take assignment of a stock when a sold option trade. It could be to acquire stock at a lower price. This is what a number of people do when they want to enter a position. They say, "Look, I want to buy." Let's use a good example. United Airlines trading at $70. I'm going to sell a $67 put, and if I get assigned at $67, I've got that's better than me buying the stock at $70 right now. So you see that when people want to acquire stock. Of course, we do this in our perpetual income trades as well. We sell when we want to acquire stock to earn a dividend. We might sell close to at the money or at least a little bit out of the money with the idea that we would like to acquire that stock. And we may even sell occasionally in the money. We have been known to do that, depending if there's a lot of skew to that side. Same thing on a call option. You have a call option where if you get taken out because you've earned the dividend and you want to move on a perpetual income stock back to the put side, and the stock runs up above your strike price, we don't mind being called out. So again, there's times when assignment is a good thing, and we take that. The last one is sometimes not. You get an option skew, you get a mispricing of the options, and you can sell an in the money option or right at the money option and collect a lot of cash. Particularly if you have an extremely bullish position but it pulls back. So I've seen this happen. There's multiple other trading scenarios where you can plan to take assignment with. But again, we mostly do this. We want to either acquire a cash stock at a discount, so we sell the cash secured put. You collect, in this case, we sell a monthly 98 cash secured put on a $100 stock. We collected $2 of credit, but the stock trades down to 97. We're signed at 98, so we keep $2 of credit for selling the $98 put, and we acquire the stock at 98, $2 below the $100 stock at the time of the trade. So we're effectively collecting that stock for basically $96. We're going to look at it that way. And on the covered call, it's the same thing. We profit from buy right or covered call. You buy the stock for $100. You sell a 101 call for $2 of credit. At expiration, the stock is traded up to 103. We do nothing, and the stock is called away. In fact, you're assigned. And you keep the $2 of credit and for selling the $101 covered call. And you also collected a dollar of a capital appreciation, so $3 or 3% for that return on that stock. So pretty straightforward. I think that part of it we get like that. We've done that a number of times in our perpetual income stocks. So let me wrap this up, and then we're going to go out and look at one of our positions here. Again, proper setup helps to avoid assignment, but it doesn't necessarily guarantee that. We need to monitor these positions. I know you probably do. Look at your accounts. I look at these all the time from what we're in because they're in my live account. So it's my money that I'm watching. Early in the days to expiration and in the money move can recover without adjusting the position. And that's, again, we watch whether it's intrinsic value and the extrinsic value as well. And we can use the option metrics to monitor those and avoid, we have tactics we can use to avoid these. So we talked a lot about that. What I want to get into then next Wednesday is really what happens when you are assigned. And we do know that we have some of the obvious things, which is, selling the stock because we have to if it's a spread trade with a large price and we don't want to keep the shares. In other cases, we may want to keep the shares. And we also know closing, if it's a spread, closing the put side. So we'll get into that. That'll be part 2 next Wednesday. And with that, what I'm going to do is actually go out to a position we have that's